Most people think turning 59 and a half means they can finally raid their 401k without consequences. That's only partially true, and the part that isn't true could cost you tens of thousands of dollars. Here's what actually happens when you reach that magic age. Let's clear something up right away. Yes, you can start taking money out of your 401k at 59 and a half without the 10% early withdrawal penalty. That penalty disappears. But here's what doesn't disappear: the taxes. Every single dollar you pull out gets added to your taxable income for that year. And depending on how much you withdraw, you could be shoving yourself into a tax bracket you never intended to reach. Think about it this way. You've spent decades building this account, watching the balance grow, and now you finally have access. The temptation is real. Maybe you want to pay off the house, buy that boat, or just have a cushion in your checking account. But the IRS is sitting there with their hand out, waiting for their cut. And their cut isn't small. Let me give you a concrete example. Say you're 60 years old, still working, and you're making $70,000 a year. You decide to pull $50,000 out of your 401k because you want to renovate the kitchen. Sounds reasonable, right? Wrong. Now your taxable income isn't $70,000 anymore, it's $120,000. You just jumped from the 12% federal tax bracket into the 22% bracket. That extra $50,000 isn't going to cost you $5,000 or $6,000 in taxes. It's going to cost you closer to $11,000, maybe more depending on your state. Nobody tells you this part in the seminars. They just say the penalty goes away at 59 and a half, and everyone cheers like they've won the lottery. But the tax bomb is still ticking. So, what's the smart move here? First, you need to understand that just because you can take money out doesn't mean you should. Access and strategy are two different animals. If you're still working and earning income, pulling large sums from your 401k is almost always a bad idea, unless you have a very specific reason and you've done the math. Here's where it gets interesting. Some people assume they should wait until they stop working to touch their 401k. That's often true, but not always. There's actually a window of opportunity that a lot of retirees miss, and it happens in those early retirement years before Social Security kicks in and before required minimum distributions start at 73. Let me paint this picture. You retire at 62. You're not taking Social Security yet because you're letting it grow. You don't have required minimum distributions because you're not 73. Your income is low. Maybe you're living off savings or a small pension. This is actually the perfect time to consider strategic Roth conversions or controlled 401k withdrawals because your tax bracket is lower than it's been in years and lower than it will be once everything else kicks in. But we're getting ahead of ourselves. Let's go back to the basics of how withdrawals actually work once you hit 59 and a half. You have options, and understanding these options is crucial. Option 1. You take a lump sum. This is where people get into trouble. The entire amount gets taxed in 1 year. Unless you're in a unique situation where you have massive deductions or you're in an unusually low income year, this is usually the worst way to do it. Option 2. Systematic withdrawals. You set up regular distributions, maybe monthly or quarterly, that give you a steady income stream. This is smarter because you can control how much you're adding to your taxable income each year. You can stay in a lower bracket and manage your tax liability. Option 3. You don't touch it at all yet. You leave it growing tax deferred until you actually need it or until you're forced to take required minimum distributions. For many people who retire with other income sources, this makes the most sense. Now here's something that surprises people. Even after 59 and a half, your 401k might still have restrictions on how you can access the money. If you're still working for the company that holds your 401k, they might not let you take withdrawals at all until you actually separate from service. This is called the still working exception, and it trips people up constantly. You might be 62, thinking you can supplement your income with 401k withdrawals while you keep working, and then you find out your plan doesn't allow it. Every plan is different. Some allow in-service distributions after 59 and a half, some don't. You need to check your specific plan documents. And here's another wrinkle. Once you do separate from service and start taking withdrawals, you need to think about withholding. By default, most 401k plans will withhold 20% for federal taxes when you take a distribution. But depending on your bracket, that might not be enough. Or it might be too much, and you're essentially giving the government an interest-free loan until you file your tax return. You can adjust your withholding, but you have to be proactive about it. If you don't specify, they're going to withhold that 20%, whether it makes sense for your situation or not. Let's talk about state taxes for a second. This is huge, and it's something people relocating in retirement need to understand. Some states don't tax retirement income at all. Others tax it fully. If you're living in California or New York, your 401k withdrawals are getting hit with state income tax on top of federal. But if you're in Florida, Texas, or Nevada, no state income tax. That's a massive difference over the course of a 20 or 30-year retirement. I've seen people retire to expensive states without considering this, and it costs them thousands every single year. Geography matters when it comes to 401k withdrawals. Here's what most financial advisors won't tell you up front. The order in which you tap your retirement accounts matters enormously. You've probably got money in different places, maybe a 401k, an IRA, a Roth IRA, some taxable brokerage accounts, savings. The sequence you withdraw from these accounts can literally create or destroy hundreds of thousands of dollars over your retirement. Generally speaking, you want to preserve your Roth accounts as long as possible because they grow tax-free and you can withdraw tax-free. But there are scenarios where taking money from a Roth early actually makes sense strategically. It's not one size fits all. The conventional wisdom used to be drain your taxable accounts first, then your tax-deferred accounts like 401s, then your Roth accounts last. But that's oversimplified. Sometimes you want to deliberately take money from your 401k in low-income years to fill up lower tax brackets, even if you don't need the money, because it reduces your balance and therefore reduces your required minimum distributions later. This is called bracket management, and it's one of the most powerful strategies available to retirees. But you have to understand how 401k withdrawals interact with your other income sources to make it work. Here's what most people miss about Medicare and 401k withdrawals. When you turn 65 and enroll in Medicare, your modified adjusted gross income from 2 years prior determines your Part B and Part D premiums. Those 401k withdrawals you're taking today, they're going to affect your Medicare costs in 2 years. This is called IRMAA, Income-Related Monthly Adjustment Amount, and it can add hundreds of dollars per month to your Medicare premiums if you cross certain thresholds. A married couple filing jointly starts hitting IRMAA surcharges once their modified adjusted gross income exceeds $206,000. Take a big 401k withdrawal to buy a car or help a kid with a down payment, and suddenly you're paying higher Medicare premiums 2 years later. Most people have no idea this connection exists until they get the bill. The thresholds aren't indexed very well to inflation either, so more and more retirees are getting caught by this. You need to be thinking about your Medicare costs when you plan your 401k withdrawals, especially large ones. Now let's discuss something almost nobody prepares for: market sequence risk. This is the danger of retiring right before a market crash. If you retire at 62 and immediately start taking withdrawals from your 401k, and then the market drops 30% in year 1 or 2 of your retirement, you're in serious trouble. You're selling shares at depressed prices to fund your living expenses, which means you're locking in losses, and you have fewer shares left to recover when the market eventually bounces back. This is completely different from what happens when you're working and contributing. During your working years, a market crash is actually good for you because you're buying shares at discount prices. But in retirement, when you're withdrawing, a crash early on can permanently damage your portfolio's ability to sustain you for 30 years. There are strategies to manage this. Having a cash buffer, maybe 2 or 3 years of living expenses set aside in stable assets, means you're not forced to sell stocks in a down market. You can live off that cash cushion while your portfolio recovers. Some people use bucket strategies, dividing their money into short-term, medium-term, and long-term buckets with different asset allocations. The point is, you can't just start pulling money from your 401k without considering what happens if the market tanks right after you retire. Here's a question I get constantly. Should you roll your 401k into an IRA when you retire, or leave it where it is? There's no universal answer, but here are the considerations. If you roll it to an IRA, you typically get more investment options and more control. You're not limited to whatever funds your employer's plan offers. You can choose your own custodian, your own advisor if you want one, and you have more flexibility with beneficiary designations and estate planning. But there are reasons to leave money in a 401k too. Some 401k plans have institutional share classes with incredibly low fees that you can't access as an individual investor. If your plan has those, moving to an IRA might actually cost you more in expenses. Also, if you retire at 55 or later, the rule of 55 lets you take penalty-free withdrawals from that specific employer's 401k. If you roll it to an IRA, you lose that advantage and you're stuck waiting until 59 and a half. Another consideration, 401k assets have slightly better creditor protection under federal law than IRAs do in some states. If asset protection is a concern for you, keeping money in the 401k might make sense. And here's one more thing. If you have highly appreciated company stock in your 401k, there's a special tax strategy called net unrealized appreciation that only works if you don't roll it to an IRA. You take the company stock as an in-kind distribution, pay ordinary income tax on just the cost basis, and then when you eventually sell it, the appreciation is taxed as long-term capital gains instead of ordinary income. This can save a fortune, but only if you handle it correctly. Let's get into something that confuses everyone: the pro rata rule and after-tax 401k contributions. Some plans allow you to make after-tax contributions beyond the normal limit. Not Roth contributions, but traditional after-tax contributions. When you withdraw money from a 401k that has both pre-tax and after-tax money in it, the IRS makes you take a proportional amount of each. You can't just withdraw the after-tax portion first and avoid taxes. It all comes out pro rata, proportionally. This gets messy fast, especially if you're trying to do a backdoor Roth conversion or some other advanced strategy. You need to track your cost basis carefully, and if you roll money around between accounts, you can accidentally create a tax nightmare. The forms for this are complicated, and if you don't report it correctly, you could end up paying tax twice on the same money. What about taking a lump sum versus periodic withdrawals? Some people want to take their entire 401k balance out at once when they retire. Maybe they want to invest it differently, or they're afraid of fees, or they just want control. Here's the problem. Taking a massive lump sum distribution creates a massive tax bill. You could easily push yourself into the top tax brackets and lose 30, 40, maybe even close to 50% of your balance to taxes, depending on your state. That's almost never a smart move unless you have very specific and unusual circumstances. Periodic withdrawals let you manage your tax liability year by year. You stay in lower brackets, you avoid IRMAA surcharges, and you give your money more time to grow tax deferred. One final thing that's critically important: beneficiary designations. When you die, your 401k goes to whoever you named as your beneficiary, and it bypasses your will entirely. I've seen families torn apart because someone forgot to update their beneficiary after a divorce or remarriage. Your ex-spouse gets the money even though you meant to leave it to your kids. Or you named your estate as beneficiary, which is almost always a mistake because it forces the money through probate and eliminates stretched distribution options for your heirs. Spouses have special rights. Non-spouse beneficiaries have different rules. If your beneficiaries are minors, there are additional complications. Check your beneficiary designations every few years. Make sure they reflect your current wishes. This isn't something you set once and forget. Taking money from your 401k after 62 isn't just about clicking a button and getting a check. Every withdrawal is a tax event, a Medicare consideration, a sequence risk decision, and a legacy planning moment all at once. Get it right and your money lasts. Get it wrong and you're scrambling at 80, trying to figure out how to pay for healthcare. Do the work now, understand the rules, and plan every withdrawal with intention. The bottom line, turning 59 and a half opens the door, but walking through it without a plan is financial suicide. You've got to coordinate your 401k withdrawals with every other piece of your retirement puzzle. Social Security timing, Medicare costs, tax bracket management, required minimum distributions down the road. It all connects. I've watched people treat their 401k like an ATM the moment they hit that age, pulling money whenever they feel like it, and then 15 years later, they're shocked that the balance is gone, and they've still got another decade or two to fund. The penalty might be gone, but the consequences of poor planning stick around forever. If you're not sure how to navigate this, talk to someone who specializes in retirement tax planning. Not just any financial advisor, someone who actually understands the tax code and how these distributions ripple through your entire financial life. Your 401k is probably one of the biggest assets you'll ever have. Treat it that way. Every dollar you pull out should have a purpose and a plan behind it. That's how you make the money last, minimize what goes to taxes, and actually enjoy the retirement you spent decades building toward.